Happy holidays from all of us here at Wealthion to all of you. I'm one of your hosts here at Wealthion, Andrew Brill. We took a look back at this year and hope you enjoy these favorite guest moments from one of our best interviews of 2024. Is the strength of the dollar a driver behind a lot of foreign investment into the U.S. stock market?
Yeah, I mean, one of my favorite charts is there's almost a perfect correlation between the relative performance of U.S. stocks and the dollar, right? U.S. stocks outperform foreign counterparts when the dollar goes up, and that's just a reflection of dollar. Money coming into dollars. Where does it go? It goes into the stock market. I thought it was interesting. Ruchir Sharma is one of my favorite editorial writers for the Financial Times. He's the chair of Rockefeller International. He wrote an interesting piece last week about, he called the mother of all bubbles in the U.S. stock market. And he kind of outlines this point that U.S. stock market has been a magnet for foreign capital for a number of years. And he was at an investment conference in Singapore recently. The moderator asked how many people in this room don't own NVIDIA, and not a single hand went up. So it just tells you, globally, everybody, wants to own the Magnificent Seven and all these stocks. And that is a trend that coincides with dollar strength. So if we are seeing potential another peak in the dollar, similar to kind of what we saw in that 2002 time frame, then we're going to probably see the outperformance of U.S. stocks potentially reverse course, and real assets probably outperform financial ones generally, just like they did from that 2002 to 2012 time frame.
So as the incoming administration and Scott Bessent trying to devalue the dollar a little bit, that would mean that there could be an outflow of cash from U.S. stocks at that point, couldn't there? And that could I don't want to say cause a crash, because I don't want to, set off any alarm bells, but it could seriously go down a little bit.
Yeah, there's a lot of foreign capital in U.S. stocks. I think there's evidence to see, Japanese investors, Korean investors, even Chinese investors support a lot of money into U.S. stocks. I think, honestly, the bigger risk I'm concerned about in the short run is not necessarily foreign capital flight. It's the fact that the few active managers left in the market today have realized the only source of outperformance or even generating returns is trying to front run passive flows. So much money has gone into passive. And Mike Green wrote an interesting piece on this over the weekend about how, literally value investing hasn't worked. Reversion to the mean hasn't worked in any respect in terms of for active investors. And what has worked is momentum. And the momentum factor over the last 12 months has had one of its, best 12-month performances in the history, going back through the market. I mean, I think it's 1999 and 2021 are kind of the only times we've come close to what we've seen. And I think that is just a function of active managers, hedge funds and these types of things, realizing when there's a lot of passive money coming into the market. We've seen record inflows into Vanguard funds and passive vehicles this year. The best way to make money is to front run those flows. And so you get a compounding effect in the markets where everything is highly leveraged to flows. And that obviously creates some fragility, because as soon as those flows, peter out or reverse course, everybody is on the same side of the boat, and that trade reverses. And I think that's something that not enough people are really paying attention to. The history of the momentum factor also shows whenever you have a year of big, strong momentum, there's usually a painful hangover on the other side of that. It's a very close correlation. It's actually a very good predictor of 12-month returns in the S&P 500, the momentum factor. So you have a really good, strong year in momentum, typically leads to a reversion in stock prices, broadly speaking, over the next 12 months.
We've had Mike on, and he is very concerned about that passive investing, because it's done a lot by algorithms. It's not even someone saying, "Okay, we're gonna invest in this." It's like, look, if one number's off slightly, Doesn't matter whether there's a good reason or not, that passive investing could flow in or out very quickly, and it's the retail investor that gets hurt.
Yeah. Yeah. And I think that, it's as I mentioned, we've seen record inflows into passive this year. And so the best performing strategy in the market has been front run those passive flows. How do you do that? You buy the biggest stocks in the market. You buy the Microsoft, Nvidia, Apple. And, I just look at a stock like Apple trading at 40 times earnings, witnessing its slowest revenue growth and earnings growth over the next, 12 months it's seen in a long time, and its highest valuation at the same time. To me, that is just the fingerprints of passive, right? Who's willing to pay a record valuation for a company that's seeing its slowest growth, going forward, and that's just price insensitive buyers. And so, on the flip side of that too, you have Warren Buffett offloading the majority of his Apple stake, because I think he's realized these dynamics that, at 40 times earnings, it's not nearly as compelling a prospect to own this stock when it was 15 times earnings and they had a bunch of, stock buybacks that they could implement in the future. I think it's also telling that, Apple's net cash relative to its market cap is essentially nil now. I mean, they essentially have almost no net cash on the balance sheet relative to their market cap, when it was, 15, 20% only a few years ago. So, that opportunity to buy back massive amounts of stock at low valuations is behind it. That's also been obviously one of the drivers. But to me, it's more a function. I think Apple's kind of a poster child of how does passive affect the market? Well, take one of the biggest, slowest growing companies and put a record valuation on it. It's not a coincidence that there's been record flows into passive this year, driving that valuation extension.
Do you see a market crash coming at all, or a big correction?
I think it's foolish to try and predict a crash, but I will say that I think if we did have a stock market crash, I think you'd have to look back and say there were signs, right? And those signs are the strength in the momentum factor, driven by this piggybacking on passive investing, and then the extreme leverage that's being used today. I would just point to, the assets in leveraged ETFs. Bloomberg published a piece, I think on Friday, that showed at the 2021 peak that the assets in leveraged long ETFs were 5 times greater than those in short ETFs. And that 5-to-1 ratio was a pretty bearish signal. Well, on Friday, we hit 11 times. So there's literally, it's twice as extreme the amount of leverage in leverage ETFs today that we saw back in 2021. There's also things like the Commitment of Traders report. You look at small speculators in S&P 500 futures, and they're about 10 times as long today as they were in 2021. So there's not only is there this piggybacking on the momentum factor, like I said, that I think is front running the passive flows, but they're utilizing such great amount of leverage in order to do that via leveraged ETFs, via futures, via these types of things, that it does concern me that once those flows reverse, and they obviously they always do, right? Nothing goes on forever, and these flows always go in cycles, right? They always go, big year, kind of a reversal year. And so I think when the flows do reverse, I am concerned to see how does the system kind of absorb this type of a deleveraging, because it's really something we haven't seen before.
Thanks again for watching these favorite moments of 2024, and we hope we can continue to provide you with information that will help you invest wisely and be financially resilient. Wishing all of you a healthy, happy, safe, and prosperous 2025.